This is Nightly Business Report with Bill Griffith and Sue Herrera.
Record finish. The market closes at all-time highs with the S&P 500 breaking through 3,200 for the first time ever as the year-end rally rolls on.
Just do it. Nike tops profit and revenue estimates, but sales in its biggest market slow down.
Picking up speed, used cars are in demand and auto dealers are cashing in. Those stories and more tonight on Nightly Business Report for this Thursday, December 19th.
And we do bid you a good evening, everybody, and welcome. The Santa Claus rally continued on Wall Street today. The market's major indexes all closed in record territory once again. There was more progress on trade when the House passed the new NAFTA agreement and the Senate passed the massive spending bills to keep the government running next year. And we'll have much more about all of that in just a moment. In the meantime, consumer staples and technology stocks led today's rally as the Nasdaq recorded its 7th straight day of gains and the S&P surpassed a key level. The Dow itself finished the day up 137 points, now to 28,376. Nasdaq rose by 59. The S&P now, as Sue mentioned, above 3,200. It added 14 today.
Dow component Nike reported better than expected quarterly revenue and profit, but sales in its key North American market slipped. That's because the world's largest footwear maker has been facing increased competition from the likes of Adidas, Vans, and Skechers, even as it has spent more on sneaker launches and celebrity endorsements. The company also said that tariffs weighed on its gross margins during the quarter. That news created volatility in the stock price in after-hours trading.
But China does remain a key market for Nike. Doing business in that country was a little tricky during the height of the China trade war. But Nike and a few other companies were able to figure out how to grow their operations there despite all of the tensions. Seema Modi showed us how they did it.
Trade tensions and a slowing economy have made China a challenging country to operate in this year. Despite these headwinds, a number of consumer companies have been able to grow their sales in the country, including Nike, which has seen its revenue from China grow steadily over the past 5 years. It's not just Nike. Analysts point to Starbucks, Procter & Gamble, Marriott, luxury retailers like LVMH and Hermes. What these companies have in common is a laser focus on the aspirational Chinese consumer that has an affinity towards Western brands. Plus, they've been expanding their retail operations as a way to strengthen their brand name in the country. Starbucks currently has 4,100 stores in 168 cities across the mainland and is planning to increase its footprint to 6,000 by 2022. Gucci and LVMH are using a similar strategy. Even though China's economy is set to cool down next year, Marriott, Hilton, and Hyatt are aggressively expanding the number of hotels. For now, these multinationals are betting that a combination of bigger investments, key partnerships with local players will win over the Chinese consumer. Experts say it appears to be working, but strategists warn that increasing their exposure to China could also make them more vulnerable to the ongoing U.S.-China trade tensions. For Nightly Business Report, Seema Modi.
The Senate today passed 2 funding bills needed to avert a government shutdown. As we reported, the House has already approved the $1.4 trillion appropriations package, which increases spending for both military and domestic programs. It also eliminates a number of healthcare industry taxes and raises the tobacco buying age to 21. That bill now goes to President Trump for his signature.
And just one day after that partisan vote to impeach President Trump last night, there was a bipartisan moment in the House today. Lawmakers overwhelmingly back the new trade agreement with Canada and Mexico. Of course, that's the president's signature deal to replace NAFTA. Kayla Tausche reports tonight on that from Washington.
A holiday gift from House Democrats to the White House.
The yeas are 385 and the nays are 41. The bill is passed.
Approving President Trump's USMCA deal with broad bipartisan support, in stark contrast to the bitter politics of impeachment. After 2 years of closed-door talks and press conferences and signings with Mexico and Canada, the Trump administration and House Democrats spent months ironing out their own compromise. The result? Higher wages for Mexican workers that Democrats say will dissuade companies from outsourcing, stricter rules for manufacturers to export products duty-free. The Congressional Budget Office says more companies will opt to pay the tariffs than make more goods in North America. America, estimating the U.S. will get $3 billion in tariff revenue as a result. One Rust Belt lawmaker says there will be unintended consequences.
The really detrimental aspects are concentrated in the auto sector. The expiration date is a problem, but I think the net effect is a little bit of lost growth, marginal.
The International Trade Commission estimates the deal would grow the economy 1/3% once it's implemented. Treasury Secretary Steven Mnuchin says it should be higher.
We're going to get in excess of 50 basis points of additional growth in GDP as a result of this agreement. And people who say this is just NAFTA 2.0 just don't understand the technicalities of this agreement. This is a whole new agreement that really brings the trading relationship into the modern era.
Mnuchin says the pact will set a precedent for every trade deal the U.S. does from here, including with China. But first, the Senate must pass it. That's expected to happen early next year. For Nightly Business Report, I'm Kayla Tausche on Capitol Hill.
Investors are the most optimistic they've been all year. According to the latest survey from AAII, a growing number of investors expect stock prices to rise over the next 6 months, while bearish sentiment fell to below its historical average. The survey attributes the upbeat outlook to the partial trade agreement with China.
And that increase in optimism seems to be helping the holiday shopping season. As Steve Leisman reports, consumers are opening their wallets.
American attitudes towards the economy taking a turn upward. Views on the economy improving. You can see the percentage saying that it's fair or poor has come down by 5 points, and a 5-point increase in those gauging the economy as good or excellent. 800 Americans polled around the country. So that's the assessment of the current state. The expectations for the economy also improving. Let's start over here. Percentage saying it's getting worse, gone down. Staying the same, within the margin of error, call it, but a pretty noticeable improvement in those who are saying the economy, in fact, will improve. Why is that? Well, we dug a little deeper in the survey. 50% of respondents saying they expect their home price to increase. That's 6 points better than the September swoon that we saw in the data. 49% saying their take-home pay will go up. That's 13 points better. That's one of the highest ones we've seen, by the way, since before the Great Recession. And all of that, part of the underlying sense of the stock market attitudes also going up. Percentage saying it's a good time to invest. 66 among the financial elite, those who have $50,000 or more in stocks. 45% among the public as a whole. I will caution you, or maybe I will advise you, each one of these peaks coincides with a peak in the stock market. This may be an excellent contrarian indicator. So anyway, put it all together. Better prospects on the economy, better prospects for jobs, home prices, upbeat views on the stock market. And then we ask about spending. 20% say they will spend more, 51% about the same, 27% would say they'll spend less. This may not look like much, this 20% number right here, but it is the highest we've had in the 13 years of the survey, and it's why we're over $900 in estimated spending per individual for the third time. Back to you guys.
Steve Leisman. Joining us to talk more about the economy, the Fed, and the financial markets is Roger Ferguson. He is the former Federal Reserve Vice Chair and currently President and CEO at TIAA. Welcome. Nice to have you with us tonight.
Thank you very much, Sue. A pleasure to be here.
That was a very positive survey that Steve Leisman just laid out. Give us your overall view of how you see the economy and the market.
So I saw 2019 as a year in which the economy slowed, and as you've just pointed out, the markets tended to rally and do better than many of us had thought. There's a risk that 2020 might turn slightly in a different direction. So the optimism Steve talked about may hold up for the economy itself, where perhaps growth starts to pick up in the U.S. and maybe other parts of the world as uncertainty recedes, particularly around these trade issues. On the other hand, the climb may be a little harder for the markets because they have been rallying so much for such a long period of time. Don't expect to necessarily see a dramatic drop-off, but I would say this is a time maybe to expect that the increase in stock valuations may slow a bit from the torrid pace that we had in 2019.
I think it's pretty safe to say right now that interest rates aren't going anywhere in 2020 for the foreseeable future. After last week's meeting, Jerome Powell made it clear that they don't plan to do anything at least through the summertime of next year. But do you worry, going back to your days as vice chair of the Fed, do you worry that these prolonged periods of low interest rates, while they're good for borrowers, they're not good for savers? You're head of TIAA now, the retirement services industry. People that rely on retirement income sometimes have to reach for that much more risk to get that income through the door.
Well, I think the answer is, in these times, the secret for retirement savers is to think broadly about diversification. So you want to have a retirement saver clearly wants to have some exposure to the equity markets because that has continued to go up. In the fixed income space, maybe thinking much more about focused on income, part of the fixed income story, as opposed to expecting interest rates to change and move in a positive direction. And more importantly, thinking about alternative asset classes, real estate, agriculture, timber. So the answer for the retirement saver in a period of low interest rates is think broad diversification. And that's not necessarily the same thing as chasing risk. It's really perhaps spreading out your risk a bit more by thinking about different asset classes that have different cycles.
You have also been a big supporter of what's called the Secure Act, which Congress has prioritized. Tell us why you think that's important as we talk about people in retirement.
Well, thanks for raising it. Yes, I and my company and many have been supporters of the Secure Act. Part of the spending bill that was passed today by the Senate and hopefully soon will be signed by the President was the Secure Act. It's really important for retirement savers because it allows them to get an annuity in their retirement plan, which then gives them the opportunity for guaranteed income for life or a private pension. It makes those annuities a bit more portable. And importantly, it allows individuals to understand how big savings they can expect out of the nest eggs that they put aside through an income illustration, as it's called. So there are a number of components about the Secure Act that I think would be very welcome for individuals and businesses who are thinking about saving successfully for retirement.
And we will be talking much more about that with you, I think, in the future. Mr. Ferguson, thanks very much for joining us.
Sue, thanks so much for having me on.
Time to take a look at some of today's downgrades and upgrades. Johnson & Johnson upgraded today to overweight from equal weight at Barclays. The analyst there called the stock a good defensive pick and said that litigation concerns involving opioids and its talcum powder are already priced into that stock right now. Price target $173. The stock rose 1.5% today to $145.35. Barclays also upgraded Cisco to overweight from equal weight. The analyst cited the company's recent product announcements. Price target $53. The shares were up about 2.5%, a little more than that, to $47.88. And Colgate-Palmolive was downgraded today to neutral from buy at Bank of America. The analyst cited market share losses in its toothpaste division and said that 2020 may be another year of investment for that company. Price target $74, but despite that downgrade, the stock actually rose a fraction today to $68.34.
Still ahead, supply is lean, demand is strong, and that means home prices are heading higher. Sales of previously owned homes fell more than expected in November. That's the second drop in 3 months. But it wasn't because of a lack of demand. It's because there's just very little supply. Diana Olick has the numbers.
As demand for existing homes surges, the shortage is only getting worse. There were just 1.66 million homes on the market at the end of November, down 5.7% compared to a year ago, and the lowest on record for the month, according to the realtors. They began tracking this in 1999. Supply is leanest on the low end, where demand is strongest. For homes priced below $100,000, inventory was down 15% annually. For those priced between $100,000 and $250,000, supplies were 7% lower annually. Supply is only growing on the high end of the market, where demand is weakest. The housing shortage has reignited home prices, which had been cooling last year and into the first months of this year. The median price for an existing home sold in November was $271,300, the highest November price reading since the realtors began tracking it.
The expectation is that prices are going to continue increasing, especially at the lower price points. At the very high end, there is supply, but there's not many buyers at the very high end of the market.
Demand began rising just as mortgage rates began falling, and now rates are a full percentage point lower than they were a year ago. Combine lower rates with a stronger job market and an aging millennial population, and the result will likely be even fewer homes for sale come spring. For Nightly Business Report, I'm Diana Olick in Washington.
Consumers are munching on Conagra brands, and that's where we begin tonight's market focus with the maker of Bird's Eye and Healthy Choice topping Wall Street earnings and revenue estimates thanks to increased demand in its snacks and its frozen food units. Now, this is the first time that Conagra has beaten sales forecast in the last 6 quarters. Shares surged nearly 16% as a result to $33.66. Darden Restaurants, the parent company of Olive Garden, Longhorn Steakhouse, and other chains, posted mixed results. They did top earnings estimates, but fell short on revenue. Company, however, did reaffirm its full-year financial forecast for 2020, but shares still fell more than 6% today to $109.03. And drugstore chain Rite Aid reported a surprisingly strong profit, which handily beat expectations, helped by strong numbers from its prescription business. The company also said it plans to announce a strategy to revitalize its retail pharmacies, and shares rose an eye-popping 42% today to $11.84. IAC Interactive is spinning off its online dating service Match Group. It'll be a fully separate company next year. IAC shareholders will get shares in the new Match company. IAC expects that deal to close in the second quarter of 2020, as a matter of fact. Both IAC and Match Group rose more than 7% in today's trade.
Accenture reported better than expected quarterly results driven by its fast-growing digital and cloud services units. The consulting firm also raised the lower end of its 2020 earnings forecast. Accenture rose more than 1% to 208.30. S&P Global cut Boeing's credit rating because of uncertainty over when the 737 MAX will be cleared to fly again. This comes a day after Moody's also downgraded Boeing's debt. Boeing shares, though, were up a fraction to $333.50. Live Nation is reportedly settling with the Justice Department over the entertainment company's ticketing practices. Reports say Live Nation will extend the consent decree that was formed in 2010 when it merged with Ticketmaster. Terms will extend an additional 5.5 years, and Live Nation will not retaliate against venues which do not sign up for Ticketmaster. Live Nation shares rose about 9% to $69.83.
All week, we've been getting you ready for the new year by bringing back some familiar market monitor guests. And tonight's guest has 3 small cap names that he says you may not know about, but could prove to be timely investments. Now, the last time he was on as a market monitor guest back in February of 2017, he recommended these 3 companies: Tower Semiconductor, which has risen 11% in that time; Knight Swift Transportation, up 12%; Kansas City Southern, up 78% since that time. Eric Marshall's back with us tonight, though, as the market monitor. He's portfolio manager at Hodges Capital. Eric, good to see you again. Welcome back.
It's good to be here, Bill.
And we start with an old name in iron ore. Cleveland Cliffs goes back to the 1800s here in the United States. It's had a very volatile history of various names. It's a small cap now, but it was 10 times this size a decade ago. Why do you like this one right now?
Well, we think this is an interesting situation. The company has really turned itself around over the last 3 or 4 years. They've reinvested heavily back into the business, and we see profitability benefiting from that over the next couple of years. They also just announced a deal to acquire AK Steel, which we think will be a great complementary fit and create additional profits. And we think the stock should be rewarded over the next year because of that.
Tower Semiconductor is second on the list. Why did you pick this one?
Well, this is a company that we think has become very timely again. They are a semiconductor foundry that's really leveraged to the build out of 5G wireless. They make semiconductors that are used in a lot of the equipment that's used to facilitate 5G. And we think that they're at the very beginning of a new growth cycle We like the valuation there, and we see substantial upside over the next year in that stock.
Yeti just came public last year. It's had a pretty good year so far. Makes those innovative cups that keep things cold and so forth. Why do you like this one?
Yeah, this is a consumer product company that really has some dynamic growth that we think is still ahead of it. And the valuation on it looks relatively compelling here to us. And it's one that's still very much under-owned and still flying underneath the radar. And that's one that we think will be a great consumer pick for us in 2020.
All right, we'll see what happens. Eric, good to see you again. Thank you. Eric Marshall with Hodges Capital tonight. And coming up, secondhand shift. As new car sales slow, used car sales are revving up. General Motors is recalling more than 814,000 pickup trucks and cars in the U.S. They're trying to fix problems with brake controls and battery cables. The recall affects Cadillac CT6 sedans, Chevy Silverado, and GMC Sierra pickup trucks. There have been no documented crashes or injuries, though.
If you recently bought a used car or truck, you're not alone. In fact, the U.S. is on pace to have a record number of pre-owned vehicles sold in 1 year. And that has made 2019 a blockbuster year for many of the publicly traded auto dealership chains. Phil LeBeau has more.
Talk about blowout sales. Americans are buying used cars at a record pace. In fact, for the fourth straight year, pre-owned sales are climbing to an all-time high, topping more than 40 million vehicles. Why are so many people buying used cars? Well, for starters, the strong economy and low unemployment means more people need a way to get around, or at least a different model. Meanwhile, new vehicle prices have surged to a record high, averaging more than $37,000, making a used car far more affordable and far more attractive.
So I think that for a lot of savvy shoppers, they're going to the used car market. They're looking for a low mileage, good deal, and there are a lot of those to be had.
Increasingly, auto dealers are buying 3- and 4-year-old models that have just been traded in because the lease was up, and those relatively new models are in demand.
Also, these vehicles are well content, and if we wind back the clock 3 years, those vehicles had a lot of the same amenities we see today. We haven't exactly had a quantum leap in amenities in the past 3 years. So for a lot of car shoppers, that's good enough.
In short, the used business has been a great business for dealers. As profits have surged, so have shares of publicly traded dealership stocks. Lithia and Sonic Automotive are both up more than 120% this year, while online used car retailer Carvana is up more than 200%.
Because more people are looking to buy used cars, prices have gone up. On average, a pre-owned model goes for about $20,000, pricier than a few years ago, but still low enough to attract buyers. Phil LeBeau, Nightly Business Report, Chicago.
And finally tonight, from cars to movies. It could be another big weekend at the box office as the 9th and final film in the latest Star Wars saga hits theaters tonight. And this one has Hollywood Boulevard buzzing. Julia Borston is at the iconic El Capitan Theater in Hollywood.
Taking one last look, sir.
Star Wars: The Rise of Skywalker opens around the world this weekend, the finale of the 9-film Star Wars saga. It's expected to bring in about $200 million in ticket sales at the North American box office this weekend. That would be the second biggest opening of the year and the 7th biggest opening of all time, but still behind the prior 2 Star Wars films' openings. The last 2 films had rave reviews. The Rise of Skywalker has just a 56% positive rating on Rotten Tomatoes.
I think in terms of this holiday, it just seems like it's going to be one of those movies that's going to have legs over the season, where it might not have the same opening as The Force Awakens, but I think it's going to be one of those that people are going to be talking about. I think the fans are going to really like this movie, and people are going to go see it several times.
Star Wars fans showing up in droves for the film's debut. This is one of 21 theaters around the country hosting overnight 9-film movie marathons ahead of The Rise of Skywalker showing tonight.
The 500 tickets for this movie marathon at $125 a piece sold out within minutes. There's a lot of excitement for The Rise of Skywalker because Disney won't be putting another Star Wars movie in theaters for another 3 years. But the media giant still has a lot riding on the franchise, both at its theme parks and at its streaming service.
Disney spent over $1 billion on each of its Star Wars lands in Orlando and Anaheim, which opened earlier this year with slower than expected launches. And Star Wars spin-off The Mandalorian is the flagship show of streaming service Disney Plus, and it has several other live-action and animated series in the works.
Action.
But regardless of how The Rise of Skywalker performs, Disney has dominated the box office this year with about 1/3 of studio market share, setting it up for some tough comparisons next year when it doesn't have a Star Wars or Avengers film.
It's going to be interesting to see how they do, because this past year we've seen a lot of franchise movies that we've come to rely on, and they're sort of breaking new ground next year.
Next year, Disney's betting on Marvel's Black Widow and live-action Mulan and Jungle Cruise movies as it enters a galaxy beyond Star Wars. For Nightly Business Report, I'm Julia Borston in Los Angeles.
Before we go, let's take a final look at the record day on Wall Street. The Dow gained 137 points, the Nasdaq rose 59, and the S&P 500 added 14. And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. See you tomorrow.